Hello, guys. Hello. Welcome to today's class. And I want to welcome you again to Study Addict Networking Group, SANG. It's a platform which allows learners and facilitators around the world to meet and share ideas on various subjects and topics. So today I'm Mr. Adesanmi, your business studies facilitator. So today we'll be looking at the common bookkeeping practice. Common bookkeeping practice. So I want you to pay attention, usually for junior secondary school. So this is a form of introduction class for them to know the common bookkeeping or accounting practice when it comes to recording of information into journals or ledger. So that's what we're doing on this video. So it's all about measuring the value of your bookkeeping. Remember, for every profession, there are ethics and practice that goes along with every profession, be it a doctor, be a lawyer, even a teacher. There are every rules and regulation that guides these professions. So also in bookkeeping, there are laws, regulations that guides this practice. So we'll be looking at those laws and regulations that guide this practice. They are called accounting conventions. Accounting conventions. So take note of that. So accountant has some principles which they must put into consideration when performing their duties. So these are policies, these are rules, these are practices they must put in place. So this has been put in place by the coming together of different accountants in the past, and these are laws that they must follow. These are rules they must follow. And whenever they are practicing accounting or bookkeeping, they must follow these rules and regulation. So we'll be looking at them one after the other. So these are some, not everything, some. The first one there is consistency. The second one is monetary measurement. The third is historical cost concept. The fourth is business entity concept. The fifth is going concern. And the seventh, which is F now, is dual concept. So we're looking at this concept one after the other, and how this concept or these principles, their meaning, and how they should be applied. Their meaning and how they should be applied. So the first we'll be looking at is the consistency. Consistency. So this means that the method used in preparing accounting must not change at will. So you can't come on board now and change your own and bring your own way of recording. No, it's wrong. You as an accountant, once you take that profession and going through the 4 walls of the university, you'll be taught all these concepts. And once you are out and you want to practice as an accountant or as a bookkeeper, you must follow these laid down rules. You can't change them because these are the rules that guide the profession. So you can't change them. Why are they there? They are there so that it will be very easy for accountants to compare notes, to compare records together. Take note of that. So you must be consistent. The rule must be consistent. You can't be changed at will. You can't change your own will. You can't say, oh, because I'm a very good accountant, I want to bring in my own way of doing things. No, it is wrong. It is wrong. It will be very difficult for another accountant to carry your record and check through, because the system you've applied, which is new, might go against the ethics, might even go against the laid down rules, which might be very difficult for another accountant to carry your record and read. So for easy aligning of comparison of data, it is good that accountant follow this rule, the laid down rule, which we call consistency. The second is monetary measurement, monetary measurement, and it applies that only transaction that can be expressed in monetary terms should be recorded inside the accounting book. I'll say that again. Only transactions that can be expressed in monetary terms should be recorded inside the accounting book, meaning transactions that have to do with money. Only such transaction can be recorded inside the accounting book. That's another rule, or that's another law that guides the profession. You can't record transaction that does not involve money inside your accounting book. Of course, we have the credit transaction with the promise to pay later. Of course, there's a book for that. We have the cash transaction when you pay immediately. So far it involves expression of money. So far money is paid or will be paid. Such transactions can be recorded in the accounting book. But any other form of transaction that does not involve money, for example, trade by barter, you give me your house, I give you my car, and you want to record it inside the accounting book, it's not possible because money is not involved there. It's just a trade by barter. You're exchanging one goods for another goods. Okay? So one of the principles of accounting is this, that money measurement concept is that transactions that have the expression of money must be recorded inside the accounting book. So let's take note of that. The next is historical cost concept. Historical cost concept. Now, this principle states that assets should only be recorded at the value of which you acquire them, not the current value or the future value of such items should be recorded, but the value of that item at present of which you bought those items should be recorded inside the accounting book. So as you can see, it said assets should only be valued at the amount paid to acquire them. Such value should be recorded. The value of asset in the book cannot reflect the future worth of that item. No, you can't record the future worth of that item in your accounting book now. No. So it is the value you acquire that commodity should be recorded. A good example is this in your left. You see a fixed asset acquired at the cost of $100,000. That is, for example, let me say car. I bought a car for $100,000. Let's record that $100,000. If its market value goes up or goes down in the future, it should be recorded at its original cost of $100,000. So if the value of the car goes up to $300,000, I can't change that to $300,000. No, because I bought that car $100,000. So that is what I have to record in my accounting book or my accounting record. I can't record the future price of such commodity in my accounting record presently. It is wrong. So it is called the historical cost concept. The historical cost concept. So take note of that. So generally now we've looked at consistency. We've looked at monetary measurement. We've also looked at historical cost concept. So we'll be looking at now is the business entity concept. Sorry about that. The business entity concept. The business entity concept. That's what it's called. Business entity concept. So accountants must regard the business as a separate entity from. So every business you see is a legal entity. So far it is registered. It is a legal entity. So it means that the business is separated from the owner. So only transactions that affect the business should be recorded. A good example is your product, Coca-Cola Company. Now it is originally founded by Mr. John, and then the founder of Coca-Cola that made it more successful is Mr. Ash. But though they are the owners of the business, but they can't bring their own personal prove the business. The business is named Coca-Cola Company, not Mr. John or Mr. Ash. Okay, so the business is separated from the owners of the organization. So only transactions that affect the business should be recorded. Mr. Ash personal money or Mr. John personal money that has to do with their own personal money can be recorded inside Coca-Cola Company's record. It is wrong. So it shows that the business is not separated. So one of the concepts in accounting or bookkeeping is this: that the business must be separated from the owner of the business. Indirectly, the business is separate, is a person, is a legal person. Under law, it is recognized as a personality on its own. A good example in Nigeria is Dangote. So Dangote is the richest man in Nigeria and also the richest man in Africa. So his company is called Dangote PLC. So though their name is Dangote, that does not mean that Dangote is personal money can enter into Dangote PLC. They are two separate persons. Dangote as the richest man, fine, but that does not affect the portfolio or the ranking of Dangote PLC in the world. We can't say Dangote PLC Dangote PLC is the richest company in the world. No, we said Dangote, Mr. Dangote is the richest man in West Africa. Not Dangote PLC is the richest company in West Africa. No, that will tell you that there are two separate persons, Mr. Dangote and Dangote PLC. So take note of that. Now, it's called business entity concept. So only transactions that affect the business will be recorded inside the business record. So the next is going consign. Now, it's a belief among the accountant or bookkeeper that anytime they are recording, there should be that knowing, an assumption that the business will continue. It should be assumed that the business enjoyed and experienced continuity. So the way they should do their record should show that the business is going to continue. It will live long. So accountants are to prepare their books on the assumption that the business is not going to crash or go under, or the business is going to fold up. No, they don't work with that assumption. So they work with the assumption that the business will go on. It's a going concern, that the business will go on. So anytime they are recording, okay, they do the recording in such a way to show that the business is moving from year 2000 to 2001, from 2001 to 2002. Their record will show the date of every transaction, believing that the business will go on. So that is another principle or another law that guides the accounting or the bookkeeping profession. So the last but not the least is concept, the dual concept. Now, this concept, as the name dual means two, it shows that for every record you record, there will be another corresponding record. So, meaning for every debit entry, there will be a corresponding credit entry. It's a law. Every transaction must be recorded twice. I'll say that again. Every transaction you see must be recorded twice. Every transaction, irrespective of how huge the money is, irrespective of the day and time of payment, every transaction you see must be recorded twice. Meaning recorded in the debit side and then in the credit side. It is called the golden rule of accounting. It is called the golden rule. So it's a golden rule. And that is why the two sides, your debit side must be equal to your credit side. They must balance. So if it does not balance, it shows that there's something wrong somewhere. So take note of this, that every debit entry must have a corresponding credit entry. It is a golden rule in accounting. So every transaction must be recorded twice. So these are the principles or the laws that guides the accounting or the bookkeeping profession. They are called accounting conventions. They are called accounting conventions. They are the policies or rules that guides these practice. So, in our next class, we'll be looking at source document. That we'll be looking at in our next class. So, till then, when we meet, take care and bye for now.